Thanks for tuning in to this week's investment audio cast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So we're going to go ahead and get started this week with our chart of the week that we featured. We called this Disinflation Intact for now. And what this chart, we got the CPI report last week, and what this chart is showing is it's showing the stock market in the top clip. And then it's showing the consumer price index in the bottom clip in orange. And then we smooth that inflation index by 6 months. So that's the average reading over the last 6 months. And we can see that this was a big story. You can see that kind of buy signal in the top clip in 2022. This has really been a big story underpinning the bull market since that time. Is you've had inflation improving or getting lower, or there's been disinflation since the fall of 2022, and that's been supportive to the equity market. Now, if inflation were to back up much further than where it is today, perhaps in the 3.2% range or so, that could be more problematic for the stock market. So that's something to watch. But for now, the disinflation trend has been intact and it's been supportive for the bull market. Now, what we've seen with inflation continuing to at least be range bound and certainly not as much of an issue as it was in 2022 is that rates have eased lower. And we can see here that year to date, the Bloomberg US Aggregate Bond Index is up 6.4%. And what that tells us is that rates have fallen and contributed to a positive return in bonds. Now, with those falling rates, we've also seen a weak US dollar. And you can see that here that year to date, the US dollar index is down about 10%. Now, both of those trends have been supportive to gains in other major asset classes, especially the stock market indices, but particularly for international stocks, where developed international stocks have returned 25% thus far this year, and emerging markets have returned 26% thus far this year. So global central bank policy easing and a softer US dollar and with the lower rates have really helped the international markets to outperform this year. Now, when we look at the macro data that we got last week, we did get a little more on the job market, and we could see that the employment trends index updated, and that's the red line in the bottom clip. And the employment trends index continues to slowly deteriorate. Now, it hasn't deteriorated enough to give a sell signal on the economy, and that's what we show in the top clip in blue is an index for the economy as a proxy for the economy. But there has been deterioration, and it's worth noting that employment trends have continued to weaken, and this corroborates the story that we got from the jobs report recently. Now, we also got an update on producer price inflation in addition to the consumer price in inflation that we showed in the first chart. And we can see here that the producer price index for final demand services fell 20 basis points in August. So we had a contraction in that, and that helped to make the PPI kind of a negative surprise. The PPI was negative for the month of August in general, led by this softening in final demand services. Now, before we cheer too much about inflation coming down, we need to consider why the PPI fell on its last update. And for that, if you look at the second clip in these black bars, that's final demand trade, and really this is trade margins. So this is the amount of margin that producers are getting, is it improving or is it getting worse? And we can see that we had an almost record contraction in final demand trade margins for the month of August. So what that tells us is that producers are potentially eating higher input costs now, and they may be doing that because of this deterioration that we just showed in the labor market. Now, the weakening labor market itself is not something that should be supportive of broad-based sustained inflation. One of the reasons is like what we saw in the PPI report, that if you have softer economic growth, producers just cannot pass through as much of the input cost increases in the consumer price index. And what we're showing here in this chart, the red line is showing disposable personal income, the year-over-year change. And it's up 4.4%, not a bad reading, but almost 2 full percentage points below the average gain in disposable personal income. Now, that series has almost a 60% correlation with consumer price inflation, which we show in blue in the top clip. So all that is to say is that when personal income is coming down because the economy is softening, that is supportive of more disinflationary trends rather than highly inflationary trends. So because of that, the Fed is likely to cut interest rates here in a couple days. And another factor in that has been the cooling in consumer sentiment. So here we're showing in the top clip, the consumer sentiment index from the University of Michigan has deteriorated in the last couple months. It's still above its year-to-date low levels, but it has been deteriorating. So this is another piece of evidence that kind of gives the Fed a green light to go ahead and cut interest rates, because you have the employment part of their dual mandate certainly weakening here. Now, if we get a rate cut here in a couple days, that should potentially be supportive of the bull market. So what we're showing here is a study from our friends at Ned Davis Research, where they showed what happens to different asset classes in the lead up to the first cut after a long pause in the cutting cycle, and then also in the days afterwards. And what we can see for the stock market, if you look at that far right column, 252 days later, the stock market has tended to be up, and it's been up on median 14.5% 1 year after the Fed resumes a rate cutting cycle. So they will have been on about a 9-month pause in cutting rates. This will be the first cut after that long pause. And if history is a guide, it could be supportive for the stock market. But it doesn't really have conclusive evidence for the rate market. So we're showing that same study here, but we're showing it for the 10-year Treasury yield. And you can see in the middle column that says 63 days before, you can see that in the 3 months leading up to the rate cut, 10-year Treasury yields have always fallen. And they've done so again this time around. But in the 252 days after, or 1 year after, it's really been a mixed bag where interest rates have been up some of these cases, they've been down some of these cases, up big in 2003, down big in 1982. So it's really inconclusive, and it's going to matter how the market starts to play out the future path of Fed policy, and that's what's going to have more influence on the 10-year from here. Now, another place where we could see some effect, especially if the Fed starts cutting more aggressively than other global central banks, is the dollar could continue its softening trend. And much like rates, the dollar has tended to fall going into the first cut after a long pause, and that has not disappointed this time around. Now, 252 days later, the dollar has tended to continue to weaken on median by another 5.6%. So that's something to watch, because the dollar falling has supported risk assets in general, and it has added ample support to international markets. Now, when we just think about the economy broadly, and I'm going to finish with maybe a little point about seeing the forest through the trees. NDR likes to do this 10 indicator recession watch report. And it shows 10 different leading indicators, and it shows key levels where they would be concerned that a recession is more imminent if those levels were breached. And they would highlight each one of these rows in red if that particular indicator was consistent with a recession. And right now you can see that none of those rows are highlighted in red. And so what that means is, out of these 10 indicators, not a single one of them is arguing that there is a high probability of an imminent recession. So taking a step back, we can say, yes, the economy is softening, but it's not yet to a point that we would be worried about recession. Now, that's important because historically, no recession, no problem for the stock market investors. So again, here in blue in the top clip, we're showing the S&P 500 index. And down in the bottom clip in red, we're showing the year-to-year change in economic growth, and that's on the left scale, and earnings growth, and that's on the right scale. And what we can see, the shaded portions are recessions. And what we can see is not only do you get negative economic growth, but you get severely negative earnings performance around recessions. And that historically has led to some of the larger bear markets that we've had in history. Outside of those recessionary periods, you can see that the market has tended to do quite well in those runs where you're not in a recession and where earnings are growing. So, right now, the evidence says that we're not in a recession, or recession is not imminent, and therefore we should expect that earnings can still have some support, and that fundamentally supports the bull market in stocks. So, closing things out on the chart of the week, inflation's ticked up lately. But the disinflationary trend does remain intact despite this potential interruption that we've had from trade policy and potentially immigration policy as well. But inflation is not a major issue for the stock market today. I'd call it more range bound than breaking out to the upside. So the Fed is likely to pivot from the inflation part of their mandate to the employment portion of their mandate here this week. And the job market has continued to slow while producers have seen a profit margin headwind and consumer sentiment is weakening. So that supports the Fed turning to a more proactive stance from an economic perspective. Now, the resumption of the cutting cycle following a long pause has historically supported bull markets for the next year, in stocks particularly, but will likely have little impact to interest rates. Interest rates tend to fall in anticipation of the restart of the cutting cycle, and that has actually happened this time around. But it could result in some more dollar depreciation, which has been an important trend, especially for international market outperformance this year. So, despite weaker macro data, there's little to suggest here that a recession is imminent. And historically, recessions have resulted in major earnings contractions and therefore major bear markets. But if you zoom out, you can see that with no recession, there's typically little problem for stocks. And that's where we think we are today. All right, well, that's what we have for you this week. As always, I want to thank you for joining us and wish you a great week ahead.